We're going to start our next panel now. And live streaming, we want to let everybody know that the live stream is back on. So welcome to the second panel of our forum today. My name is Dave Szyminski. I'm with the Office of Financial Empowerment at the CFPB. You've just heard a great panel of representatives from financial institutions and credit reporting agencies that help to better inform us how the check screening system works, and we want to thank them for their willing to participate and for their candor. We're now going to hear another perspective, the voice and experience of consumers that interface with the system. We have a terrific panel of subject matter experts who will provide you with a fuller picture of what consumers understand about their legal rights, what information they might receive if they apply for an account and are turned down, some ideas for reforms of the system, and some ways that consumers can correct problems when they have a challenge with their banking history. So, like the previous panel, we will save the last 15 minutes for audience questions. So, joining us today to moderate the panel, first is Jonathan Mintz, who's the President and Chief Executive Officer for the Cities for Financial Empowerment Fund, a national nonprofit that supports municipal efforts to help low-income families and individuals achieve long-term financial stability. Jonathan also founded and co-chaired the Cities for Financial Empowerment Coalition. Prior to his current position, Jonathan was the longest-serving commissioner of New York City Department of Consumer Affairs under Mayor Mike Bloomberg. Also on the panel are Chi-Chi Wu, who's a staff attorney with the National Consumer Law Center. Chi-Chi focuses on consumer credit issues at the NCLC, including legislative, administrative, and other advocacy. Chi-Chi's specialties include fair credit reporting, credit cards, refund anticipation loans, and medical debt. Chi-Chi's the co-author of the legal manuals Fair Credit Reporting Act and Collection Actions, and a contributing author to the Consumer Credit Regulation and Truth in Lending. Next is Nancy Ewell. She's the Executive Director of Innovative Changes, a community development finance institution loan fund in Portland, Oregon. And thank you, Nancy, for traveling all this way to join us. Innovative Changes helps people build their long-term financial health by providing financial education, coaching, small dollar lending, credit building loans, and match saving services. Nancy is a founding member of the steering committee of Bank on Oregon, and she chairs the Financial Education Committee for Bank on Oregon. And Anthony Santiago is a certified public manager and senior fellow at the Institute for Youth, Education, and Families at the National League of Cities. Anthony focuses on partnership and program development and supports municipal leadership in collaborating with the Institute to improve outcomes for children and families, while also supporting its Family Economic Success portfolio. And prior to joining the National League of Cities, Anthony was Mayor Cory Booker's Deputy Chief of Staff in Newark and the leader of the city's Bank on Newark program. So with that, I'll turn it over to Jonathan.
Thank you so much, Dave. I want to thank the CFPB for putting this together. In fact, I want to thank them with a little extensively. As Dave mentioned, I used to work in government, and when that ended at the end of December, at the end of our term, I became, I think, a government groupie. And I realized that recently when I participated in a panel discussion and a screening at the New School, which is in the West Village of New York. Let me just give you all sort of a tip. If you are ever asked to be on a panel in the West Village of New York, you should do shots before. And the reason is because you get really wacky questions that, take 20 minutes and that are, substance fueled. And so you got to meet them where they are, so that's what I'm saying. But the one question that I really enjoyed the most is after somebody gave us what seemed like a 47-hour treatise on slavery, he said, "Therefore, what is government?" Needless to say, the panel had nothing to do with slavery and nothing to do with government as a whole, but that's kind of my thing, and now I'm a government groupie. And one of the things that I said to try to deftly change the conversation from slavery was I talked a little bit about how I thought that what had been most fun in our experience in the Bloomberg administration with the reins of power of government was the ability to use it to really take on tough issues. And I think that I really have to tip my hat to the CFPB. I think that today is an extraordinary moment on as the director put it, a largely invisible issue. And bringing it to the light of day with all of the right players through the lens of the regulators, opening the doors and asking all the right questions and facilitating others to ask and answer those questions on this critical but hidden issue, I think is just key. So I'm really delighted and very, very appreciative. I want to talk for a few minutes as an introduction to our panel on the consumer experience, which I think dovetails really nicely with that excellent panel before us, about our experience with CRAs and how this sort of secret issue hit our radar and why it became so important. Our perspective in government on banking access was always thinking about, and continues through Bank on 2.0, to be thinking about scale. And if you're going to have players out there that are trying to, at scale, connect the unbanked to appropriate banking products, then you're going to have to be putting together infrastructure and systems and programs where the flow of dollars, for example, creates a banking moment. And so one project that we worked on with the Treasury Department, I know Louisa Quitman is here, when we were in New York, was we worked with this temporary workforce program, the largest temporary workforce program in city government in New York, which is through the Parks Department. And we took the moment of registering people into that program and registering them for payments as an opportunity to say, well, let's harness this flow of money, let's harness our control of the registration system and get these people banked, because probably a huge percentage of them won't be. We found, in that case, a great banking partner, and that banking partner said to us, look, we know that the CRA system, this account screening system, can sometimes be a problem. We know that you can't put together this big program and have everybody sort of run into a brick wall, and so we pledge to you that we will be, I think the word that they used is flexible, about any hits that come up on people that you have flowing through this massive, many, many thousands of people program. However, they said, completely reasonably, if somebody flags for fraud, then obviously, we're not going to bank them. And our reaction to that was, of course, that all seems quite reasonable. So the good news is we had a great program partner who was willing to allow us to use their program as a little bit of a banking access Trojan horse, allowed us to turn the registration into this workforce program into a banking access moment. The good news is we had a terrific banking partner who said all the right things and meant them about, as best we could tell, meant them about dealing with CRA. And then we turned on the spigot. And we started saying to people, oh, by the way, you're going to need little behavioral economic nudges. You're going to need direct deposit. You don't have an account. That's no problem. Here's a safe account that the city negotiated for you. Why don't you sign up? And so thousands of people were unbanked. Great majority of those who were unbanked said, yeah, sure, that's fine. If that's how I'm going to get paid, I'll open up a safe account. 46% of them were flagged. 46% of them. Now, I can assure you that this is not like a prisoner reentry program. This was not, hanging out outside of Rikers, looking for people to pull into the program. This was just a regular, general access, low and some very low, moderate income program. 46% of them were flagged as being on the in that case, I believe it was check system list. And guess how many of them were flagged for fraud? Not 1%, 38%. So from our perspective in New York, we walked away with two major headlines. One was that you could set up large-scale approaches to harnessing public programs and public dollars into banking access. That the banks will work with you, that the program partners will work with you, and that if you do it the right way, the unbanked will say, yes, I will become banked. The second major headline is that the CRA system, in our experience, presented an insurmountable brick wall into which all of these efforts slammed. And so I think that one of the themes that we'll be talking about with our panelists, if I ever decide to stop talking, is more about this consumer experience, more about the realities of what the consumers and those who are working with the consumers are seeing from their end of it, and I think a really great opportunity to have a sort of a dialogue in retrospect with the last panel. One more note that I want to put in here, one of the projects that we fund at the CFE Fund is another Trojan horse perspective to banking access. We're working with summer youth employment programs, funding a bunch of programs around the country to turn the moment of registering for summer youth employment into another banking access moment, and we have some preliminary data from one of our partners that I thought was relevant and sort of shocking. We had 180 youth that we were working with in particular on banking access in the Los Angeles Summer Youth Employment Program for this project that we're doing, Summer Jobs Connect. 40 out of the 180 were flagged on the CRA list. Now, I don't have, unfortunately, we didn't get a breakdown of how many of them were fraud, but now we're talking about very young adults, probably their first job experience, and already a huge percentage of them are blocked out of the system or at least in trouble with the system. And this is young adults as well. So I hope that really tries to frame this perspective a little bit. The question that I'd like to begin our panel discussion with is similar, which is to ask each panelist how they and their organizations came upon this issue, how it hit their radar, and their sense of how big a blip it existed on the radar. So I'm going to start at the end, maybe, and start with you, Nancy.
Thanks, Jonathan. Well, as mentioned in my introduction, Innovative Changes is a small dollar lender, and we lend as an alternative to payday lending. We also do a lot of credit building lending, and we're able to use our membership in the Credit Builders Alliance to report our borrowers' activities to build their credit scores. In addition, we pair that lending with a lot of financial education, both classroom-based and one-on-one coaching. We serve about 1,000 people a year, and 70% of them are women, usually single heads of household, and the vast majority of our clients are people of low income. We find that about 15 to 20% of the folks we interact with are either unbanked or underbanked. So a lot of folks are out there using alternative systems to manage their money. Every week we're holding classes that are open to the public on financial education, and one of the topics is banking. And in that class we talk about the screening agencies, the industry, and inevitably there's always at least one person in the class who's had experience. They've had an account closed down involuntarily, they've been screened out, they've been turned down. But by and large, everyone else in the class doesn't even know about the industry, doesn't know it exists. And even those who have been screened out don't know how to get back in. There's just a great absence of information on how it works from the consumer's standpoint. And the reason folks are screened out is varied. When there is fraud, oftentimes people tell us they were the victim. Someone passed them a bad check that they deposited. Other times it was a simple mistake. We had a mother whose daughter put an empty deposit envelope into an ATM, and she was flagged for fraud. Now here's a family who's trying to teach their children about banking. What do you think they learned, right? Oftentimes there's a lot of emotion attached to bank accounts. Say it's a joint account and the marriage ends, and that account is left open but not managed. And it's incumbent upon that person to go back and clear up those items. Well, imagine how emotionally embedded those items are in that experience. And all people really want, they tell us time and again, is just to have a chance to explain their situation. And I really appreciated the panel this morning because everyone said we do talk to our clients. We listen, we let them tell their story, we let them come up with a plan. My clients don't have that experience as often. More often than not, they're dealing with folks who aren't really willing to listen, to come up with a plan, to help them be successful. And so they get very frustrated. And what people don't understand is when they walk away from an overdraft fee or an NSF fee, they don't realize that it's going to hang out there for years, that it's in a system that will haunt them. They think it's just with that one bank and that they can go to another bank and start fresh. They just don't realize it's there for them. So that's very, very difficult for them. It's often common that folks will talk about how the system is really unfair. And it's often tied to also talking about bank fees. People feel that it's unpredictable. They're not sure when they're going to have an involuntary account closure. And we heard this morning, there is variability in how different financial institutions deal with when they pull that trigger on closing an account, when they report. And that unpredictability adds to the notion of it being unfair. So people get very frustrated and they walk away. And they end up in a situation that really concerns us because they're very vulnerable now, once they're unbanked, to being taken advantage of. Their funds aren't safe, they're incurring high fees, and they're very vulnerable to predatory products. So it's a real concern for us.
Chi-Chi, how did this issue hit your radar, your organization's radar?
Well, I think the interesting thing is maybe not how it hit our radar, but how much it did or didn't hit our radar. So as some of you know, I work for a National Consumer Law Center. We're a policy and advocacy group that works on consumer credit issues focusing on low-income Americans. We don't really deal with consumers on a one-to-one basis, so I usually don't have direct consumer anecdotes. What happens is we work with a lot of the field legal services programs and private attorneys that represent low-income consumers about various consumer reporting issues. And one of my focuses is consumer reporting. You know, as Dave mentioned, I co-author the manual on it. And so, you know, with respect to the big three nationwide consumer reporting agencies, you know, Equifax, Experian, TransUnion, we have a fair amount of information. We do a lot of advocacy. We kind of know the system pretty well. In fact, you know, usually I'm on the panel with Stuart Pratt from the first panel, and I actually feel a little weird not to be on the same panel with him. You know, we have a lot of information. And then, you know, we have some information on other types of specialty CRAs, background screening agencies, tenant screening. We didn't have that much on check systems. I mean, we knew that they were a consumer reporting agency. We knew, you know, they kept information for 5 years. You know, in terms of legal cases and attorneys we worked with, bringing up issues, you know, we didn't have that much information. And so, you know, I remember one time actually being in a forum with you, Jonathan, with a bunch of other city folks, Cities for Financial Empowerment folks, and they, you know, a couple of people were like, well, what, you know, you've just talked about the big three nationwide CRAs. What about check systems? And I was like, well, I can tell you they're a CRA and I can tell you the FCRA requirements, but I don't have that much to give you. So then Jonathan's group, the Cities for Financial Empowerment Fund, actually asked us to do a little issue brief on account screening CRAs, such as check systems and early warning and the other players in this area. And so I started looking at this, and I just realized the depth of how little I knew about it. And then this piece, by the way, is available here, and we're happy to provide copies from, is it Suzanne has it? Okay. You know, for example, this whole idea that there's a score associated with account screening CRAs, I had never heard of these scores, the Qualifile score. You know, I had never heard that, you know, in addition to account closures, the information includes things like your check orders and your driver's license record. So it was really startling to me, the amount I didn't know. And if, you know, me, who is one of the consumer advocates who focuses on consumer reporting a lot, didn't know a hell heck of a lot about this. What chance does the average consumer have in navigating this system? I'm actually very eager to be here today to hear more about what goes on with account screening.
Yeah. Hi. Unlike the National League of Cities, which has a more broader focus on providing technical assistance and capacity building to electeds on those regular aspects of managing a city, the Institute for Youth Education and Families, we have a focus on, again, positive outcomes for children and families. So this issue really came upon our radar through our work in the Bank On efforts and replicating or assisting and providing technical assistance and replicating Bank On around the country. Having been a local kind of program manager, really I have a bit of an intimate experience in how CRAs are impacting folks on the ground. And what really kind of came to light were three main areas. One, CRAs, the fact that they exist is this kind of like unknown system. People know about credit reports. They know about the three agencies. They know what's on their credit report. They might not like what's on it, but they at least have a method and a process for pulling their credit report and identifying what shouldn't be on there and working toward resolving it. The issues behind the CRA systems are a little bit less clear and they're less aware. So I certainly want to underscore what a point that Cecilia was making earlier is about communication. And I think if I was to step back and say there being a goal for us, and it's one about better communication and collaboration, not just with the financial institutions, but specifically with the financial institutions, the advocates, the CBOs that are working toward poverty reduction and helping increase prosperity around our cities, and local electeds. Because I think as much as this is a national issue, a lot of solutions end up coming out are manifesting themselves locally. And if local financial institution leaders had a little bit more ability to kind of change procedures, I think you would see a little more inclusion for a lot of the folks that we're talking about today.
I think one of the dynamics that's hard for a lot of us to get our head around is, on the one hand, we hear, and we heard a little bit of this in the first panel, that this is sort of a private sector way of financial institutions communicating with each other, and that's maybe part of why this hasn't hit many of our radar screens until it hit us like a brick wall. On the other hand, we also hear a lot of references, including from the financial institutions and the industry reps, to requirements under the Fair Credit Reporting Act. I played the role of terrible boss and asked Suzanne Reisman, who we hired to run our Bank On 2.0 initiative. I said, well, go find out what the banks are doing, about the check system. Of course, that was an impossible assignment. I officially absolve you of not knowing the answer. But I wonder if we could, if Chi-Chi, if from your perspective, you could school us a little bit on that part of this conversation, which actually is squarely a regulatory matter, and try to marry what we already know about the FCRA and what we are trying to learn about the CRAs.
Okay, sure. I'm happy to talk about that.
Great.
Under the Fair Credit Reporting Act, as probably most of you know, there are certain notices that are required to be provided to consumers. So when information goes into the system, when there's negative or whatever reporting, but especially negative reporting from an institution such as a bank, which we call the furnisher, there's actually no notice. At that point, there's no notice to the consumer. There is something called the negative information notice, but it actually only applies to reporting to the big three nationwide CRAs. And it's a bit of a boilerplate, it's buried in the account agreement in mice type kind of thing. Where consumers are supposed to get meaningful notices about the existence of account screening CRAs and that they're in the system and it's negatively affecting them is when they go to apply for a bank account and they're turned down on the basis of an account screening CRA. They're supposed to get what's called an adverse action notice, and it's supposed to, give them, tell them you've been turned down for information from a CRA. This is the contact information. Go get your report. And so at that point, the consumer should know that this is an issue and a history exists at one of these CRAs. Whether there's universal compliance with this. I know in the background screening area with employers, we've seen a fair amount of noncompliance. So the other information notice that I think is relevant here is, and most of you know, the Dodd-Frank Act required users of credit scores when that credit score is used for an adverse action to provide the actual score that was used. Now, there's some debate probably as to whether these scores are credit scores. We think there is an argument there is, because we think overdraft is a form of credit, plus if there's things like cross-selling going on, then it's being used for credit. And in fact, FIS, which is the parent company of ChexSystems, did put out a guidance a few years ago advising institutions this is how you comply with the Dodd-Frank scoring disclosure requirements when you take an adverse action on the basis of a score. So we think some consumers should be getting these scores, and the fact that we don't know if there are any, but certainly I've never seen one or heard about a consumer getting one of these like qualified scores. Certainly makes me raise my eyebrow. One other transparency issue that I wanted to talk about under the FCRA, there's a lesser known provision in the FCRA that says if a consumer report is used to take an adverse action against a consumer, the CRA cannot prohibit the user from sharing that report to the consumer. Now, in my research, I've been hearing sort of anecdotally that there may be contract provisions between the CRAs and the financial institutions saying you can't share the report with the consumer. To the extent the report was, and I think I heard earlier in the panel, the earlier panel, one of the panelists may be mentioning, the frustration of not being able to share information. If it's due to such a contract provision, so I want to say right now, under the FCRA, if the report's used to take an adverse action, the CRA is not supposed to be able to prohibit you from the institution from sharing it. And certainly being able to share those reports with your customers when you turn them down, I think would educate a lot of consumers and be very helpful, because I think the process of actually ordering the report from the account screening CRAs is a little bit more cumbersome than if the consumer's right in front of you and you're able to share the report and say, here, this is what the problem is.
Can I, building off of that, can I ask our other two panelists, you're hearing from Chi-Chi's perspective that there are, one, probably two, maybe three things that might be owed to a consumer in terms of notification and opportunities. The adverse action notice, a score, or some, I assume, approximation of a score, and perhaps actually access to information or report. Anthony, I'll start with you and then move to Nancy. In your perspective, in your work over your career, what are you seeing as the actual consumer experience on compliance there?
So it would be difficult to say that those notices didn't go out, but certainly the message wasn't coming across. So I go back to the earlier point about how effective communication is being handled. And so I said I was going to mention 3 points. I only mentioned one, which was the ambiguity with CRAs. The other is just, again, misinformation from peers and family. So if you have a culture that might be traditionally unbanked, and then someone kind of like, crosses the Rubicon to kind of open this traditional financial relationship and then gets knocked down for whatever reason, they're going to go back to their community and their folks and just kind of share that experience without having clear understanding of why they were denied a checking account, for instance. Again, it might circulate a message that we're just not welcome there. So again, when I talk about cultural competence, I'm not just talking about language or, sending forms out in Spanish. You have a lot of different complexities and richness in a lot of our cities. I mean, so we could talk about, the same cultural competence in like the hollows of Kentucky that we're talking about within, some of the ethnic areas within the great city of Newark. So certainly what we weren't getting was that, I was denied, but I wasn't clear why I was denied, and that was the message that was circulating around our Bank on Newark folks.
So, for example, you weren't getting people that came in and handed somebody on your team an adverse action notice and said, I tried, or I can't.
Right, it just wasn't coming across. But again, I just want to say also part of what was our solution was having that Bank on Newark coalition, and so having institutions that were really willing and able to kind of have a deeper conversation was a key part to getting those people back in line.
Nancy, from your perspective? what is the actual consumer experience as, and how does it correlate with Chi-Chi's shortlist?
Right, thanks, Jonathan. I would really echo what Anthony has said. The notices may have gone out, but folks either don't understand them or don't get them or don't save them. And in addition to sort of the cultural aspects, there's tremendous shame and stigma when you are shut out of a bank account. And I just wanted to read a really brief quote from a woman who we helped get a second chance bank account. When she finally got the bank account, she said, "It's literally changed my life. I don't have to pay all these extra fees just so I can pay my bills and cash my checks. I feel like a functioning member of society again." That's what it means to be screened out. That's really what it means. When folks do learn that they can do something about it and they come to us for a coaching session to work on it, they typically are ready. They've set aside an hour of their time to work on issues, and they say, yeah, I want to figure out how to get banked now. I'll tell you what, getting that screening report doesn't help at that moment. Have any of you tried to get your screening report on your debit accounts? Yeah, how did that go? Not so good. So I ordered mine on September 29th. I haven't gotten it yet. It's not real time, right? At a bank it is. You're getting it live when you order it, I assume. But for a consumer, it gets mailed to them, and it can take what probably feels like forever. But if I've got that person in the office with me doing a coaching session about banking, and they're ready to act at that moment, we know from behavioral economics, that's when you do it. You don't say come back in a week and a half when you have that report. So we don't use the screening reports. We use credit reports to figure out what they owe and to start negotiating. And my staff spend hours with these folks on the phones with banks. They tell their story. Often it's very emotional. They get put on hold. They get transferred. They tell their story, go through it all again, get transferred, get transferred. And what we're finding is when our clients are trying to really negotiate a payment plan with the banks, they're a lot less flexible than debt collectors. So it's really hard for people to overcome these hurdles. And it's very frustrating for them. It's very time-consuming. What we have had in the past are some small community banks who are willing to give our folks second chance bank accounts. Those banks are getting merged with regional banks. We're having less and less opportunities for that. So folks aren't really aware of how to correct the issue. When they are aware, there's not good information. And the folks that the financial institutions we've been dealing with have not been as helpful as the members of the panel this morning in helping people to get banked again.
I want to build off a little bit. I mean, there's so many nuances to this issue, and I want to build off this question of, well, what happens when people find themselves flagged on the list? We heard a lot of really interesting information and opinions in the first panel about the fraud issue, and I want to put aside sort of what is fraud and does everyone mean what they say and are they all right? Put that aside for one moment. But I want to talk about errors. I want to talk about the resolution part of this equation of where people are on the system in error. And a couple of examples, and we even heard some in the first panel, of where an account was flagged for fraud, but it wasn't the fraud of the customer, it was some other fraud. And so I want to start again with you, Chi-Chi, and talk a little bit, if you could, about what are the requirements and, from your perspective, the experiences on the resolution side of errors in placement on check system and or errors in the way they were coded in check system or other CRA lists.
Okay, thanks, Jonathan, for that question. So I want to start the discussion by talking about what's legally required under the Fair Credit Reporting Act, and also what some of the nuances what we think is legally required. So under the Fair Credit Reporting Act, there are a couple of obligations on consumer reporting agencies as well as furnishers, i.e., banks and financial institutions that supply information. For consumer reporting agencies, they are supposed to have reasonable procedures to assure maximum possible accuracy. And that phrase is important because it doesn't just mean some accuracy, it doesn't mean technical accuracy, it means maximum possible accuracy. And so, certain errors, for example, one of the complaints we've also heard is that consumers who are victims of fraud Common one is the Western Union scams. They are often, their accounts are flagged as fraud or suspected fraud, but it's not made clear that they were the victim, not the perpetrator. That is not maximum possible accuracy. It's technical accuracy. Yes, there was fraud involved in that account, but that information's incomplete because it doesn't indicate that the consumer was the victim, and it's misleading. And misleading information is inaccurate under the FCRA. So to the extent that you see some of these errors, there is the ability to report on account screening CRAs when an overdraft is paid or unpaid. We, I think, heard a little bit in the earlier panel, and we've certainly seen complaints where consumers have complained that they've paid their debt to the bank, and it has not been reflected on a consumer report. That, again, is a violation of maximum possible accuracy. The fact that it was paid the fact that it was paid and that's not noted is incomplete, again, misleading information. Furnishers, banks are also subject to an accuracy requirement. It's a somewhat different standard. They're not supposed to supply information that they know or have reasonable cause to believe is inaccurate. But there are accuracy obligations imposed on furnishers. Then there are obligations under the FCRA to conduct a reasonable investigation. So let's say a consumer who says, fraud, I was the victim of fraud. I was not the perpetrator. And they file a complaint with the account screening CRA, with the furnisher. We advise, actually, they do both at the same time. There's supposed to be a reasonable investigation, which under the law is supposed to be a meaningful substantive inquiry. Now, those of you who know me and heard me talk about the big three nationwide CRAs know I've got a lot of criticisms of how they handle investigations, and the fact that it's very perfunctory, and the fact that they entirely defer to whatever the furnisher says. Well, I'm sorry to say that, unfortunately, the account screening CRAs aren't much different. From the cases we've seen, they also do the same thing. They rely entirely and defer entirely to what the banks say. They don't conduct their own independent inquiry. And then the banks in turn, some probably are better than others, but there's certainly some that are perfunctory. And for example, a court in one case that said, the messages that the consumer received from the CRA explaining its reinvestigation process would have been extraordinarily frustrating to him as an innocent victim of identity theft. The CRA's messages suggest it entirely relied on Chase's investigation of the account, or perhaps only conducted a very minimal reinvestigation of its own. The messages do not show the CRA made any effort to verify that the consumer himself, as opposed to the identity thief, opened and used the fraudulent account. And so the court concluded that it indicated the CRAs were not taking the complaint seriously. And unfortunately, I don't think that's an isolated incident.
Nancy, from your perspective, what's your client's experience with trying to resolve issues? I think by the very nature of this system, you have people communicating with each other through middlemen who aren't necessarily interested in communicating with each other, and as we heard in the first panel, aren't using the same language when they're communicating with each other. So it's a frustrating system it sounds like for the users as well. From the consumer perspective on this issue of there was an error, this is a miscode of my experience, what are you seeing in the resolution territory?
Sure. So, it varies financial institution to financial institution, but by and large, it's very frustrating for the consumer to get accurate information, get it corrected on the reports. They've got to move the two different pieces, both the financial institution and the reporting agency. And that's a lot of effort for someone who's juggling many things in their life to keep their head above water. So often they get so frustrated and disheartened, and there's all that shame too, that they give up and they just decide to be unbanked. There's systems out there that they can function in, and so they say, you know what, I'm not going to bother. They charged me too much to begin with. They didn't have accurate information on my report. I'm just not even going to bother with this. It's too hard to navigate. I'm going to work in the unbanked arena.
there's obviously plenty of frustration to go around. I mean, we wouldn't be here today if there wasn't, right? And it sounds like part of what financial institutions are a little bit frustrated by is even internal consistency issues about, do we know that we're charging off the same from branch to branch? Do we know that this is the difference between fraud and account abuse or account mismanagement, et cetera? And then from the consumer perspective, this issue of frustration around resolution. Anthony, I want to have you weigh in a little bit on this, because I know that from banking access efforts like Bank On, you go to extraordinary lengths to get somebody to say, yes, I'm willing to open a bank account, and in many cases, open a bank account again. And so what's your experience with their ability to resolve errors, and I guess to Nancy's point, their appetite for resolving those errors?
So each Bank On program has a criteria. One of the criteria that we wanted to look for was a pathway for opening up a bank account, not including fraud, but whether someone stumbled or made a couple of legitimate mistakes in their past, there would be some sort of avenue to get back in. And a lot of times we would look at where the charge was over 12 months or below a certain amount. And so the experience really was a mixed bag prior to kind of like setting this pathway with our agreed upon Bank On partners. Now, mind you, those are the folks that were participating in the Bank On. That's not every financial institution in the city. And so the experiences were one of three. They would basically get a letter and saying, you know, make the institution whole, and you can, once you prove that you made them whole, come on back, we'll welcome you. But it's like, you know, go talk to Bank of America, and then once you straighten that out, then we'll consider opening an account for you. The other was, hey, it's not our bank, so come on. So it's completely different, but legitimate. The other one was, I'm sorry, we can't open this account for you. Goodbye, have a nice day. And so, again, you hope that the notification goes out and explains to the individuals why they're being sent away, but that there's no guarantee.
You can't talk about the consumer experience of being flagged on this list and either having to resolve or block without also talking about, as it was raised in the first panel, so-called second chance accounts and approaches that financial institutions will take sometimes to work with a customer that they would like to bring in, or for programmatic partners to try to coordinate with financial institutions to say, well, let's minimize the risk with a second chance account. And second chance accounts, generally speaking, have more limited functionality that can mitigate the possibility of future problems. I wonder how this panel, from a consumer perspective, would comment on this difficult question around second chance accounts as being part of the solution, which is that a great solution because that can be sort of a so-called side door or back door back into the banking system, or is that unacceptable as a primary solution because of the limited functionality? And we heard some interesting comments about that in the first panel. I wonder how you all might respond. Anthony, should we start with you?
Yeah, I have to. So, you know, working as a part of a local administration, and I think also, you know, coming back up to our perspective on NLC, we really wanted there to be pathways for folks. And if you think about banking, it's a basic building block to prosperity. So you know, to not have access to a checking account can be a serious impediment. And so I think, you know, again, as long as there's some sort of avenue to start down that road to get your hands on that basic building block, it's a good thing.
Nancy?
I totally agree. I think that this is exactly what the consumers we work with want, is that second chance. They want to prove they can do well. They don't mind that there's limited services. They want the basics, and they want to be able to prove that they can do well. They want it to be a door to perhaps more full-service products over time, but initially they just want to get that chance to try and show that they now are in a position where they can manage an account well.
Chi-Chi?
So I do think that the solutions to account screening, you know, involve more than regulation and enforcement and supervision. They do involve marketplace solutions. You know.
What did you say?
Did
everyone get that?
Recorded. Oh my God, she said that. That's all right. So I think that, you know, second chance accounts are definitely one element. I think that some of the technological innovations, we've also learned about, other accounts where they're using, mobile banking tools so that consumers can actually have checking, but not have a risk of overdrawing their account. Simple seems to be one. GoBank from Green Dot seems to be one. So certainly, that's one thing. I do think, though, that regulation does play a role in also the account features, and certainly, the big, I don't even know if you call it elephant, but the big trigger in a lot of this is overdraft. And as you know, one of the issues I work on is overdraft, and overdraft practices have really, I think, driven some consumers out of banking, really hurt them, saddled them with these negative histories. And I think, some of the reforms necessary for overdraft so that all of these bank accounts are safer. For example, no overdrafts on debit cards. Why is there a reason for that? I think would make all bank accounts safer so that you don't have people who end up on the list in the first place.
So in other words, so part of what you're saying is that the beauty of a second chance account is that it usually screens out overdraft.
Right,
Yeah.
right. In fact, some of the earlier panelists, I think I'm not the only one in the room who feels this. Some of the early panelists mentioned that, one way of dealing with this is to make the account safer. And certainly one of the aspects is that it's overdraft. But, that safety of that account shouldn't be limited to just second chance accounts. It should be for all accounts.
I want to play off that and ask the panel for the reaction to a related exchange that I thought was interesting in the first panel about the role that financial literacy and education plays in this equation. I wonder what your reaction was to the financial literacy component of this conversation. Nancy, should we start with you?
Sure. We do a lot of financial education, but it doesn't really have an impact until it's paired with a good product and a good tool. And so that's really financial capabilities, isn't it? So it's good to teach people how to manage their account well, how to balance, how to track, but they also need access to safe and responsible products to be using. And I agree with Chi-Chi. I think overdraft fees are a huge problem for folks, and we do need more regulation on that. Make the product safer for people. When that's paired with financial education, then they can be successful. But just saying, just educate consumers about this, that's not enough. You have to look more broadly. You have to give them the information, the ability to make good decisions, the choices to have good products, and safe products, fundamentally.
Chi-Chi, in thinking about it from the primarily regulatory and advocacy and enforcement sort of lens, what's your reaction when you hear that part of this problem is about people's ability to understand accounts and therefore use them appropriately?
So, I've always been a little skeptical of the term financial literacy and financial education. It was used sort of pre-Dodd-Frank, pre-Credit Card Act. It was used to cover a lot of abuses. Consumers need to know how to handle credit. No, the problem is that the credit was full of tricks and traps, and how do you expect a consumer to understand payment allocations? So. I always approach it with some skepticism. Information certainly is valuable, and to the extent there's education on how to use a bank account, that's valuable, but you also need, as Nancy says, safe products, and you also need transparency. So I would turn it from financial literacy to transparency. You can't educate someone when you don't know, for example, what are the standards? What are the standards to categorize something as fraud versus account abuse? What are the standards used by banks to do a screening when there's a negative history? I think there was an FDIC survey that found about for half of banks, the decision about whether to open an account if there's a negative history on an account screening CRA goes to the branch manager. What are the criteria being used? A lot of that's just not transparent. So certainly, how do you inform consumers if you don't know what's going on?
Anthony, the question to you is not, is financial literacy a good idea, attainable and important? We could either spend an entire week on that or, from another perspective, 4 seconds on that. The question is, I think, its place in the debate around CRAs. What's your thought?
I echo Chi-Chi's sentiment about transparency. And again, having a rule on the books saying that you're supposed to make people aware is one thing, and being up in front and playing a lead role in making sure that that communication goes out is, I think, something else entirely.
So let's build off that. I think we have time for maybe one more question before we can get to the audience. We've been talking about this from the consumer perspective. We heard a lot of really interesting and thoughtful perspectives from the financial institution perspective. But from the consumer perspective, how do you think about reforms that are responsive to the consumer experience that might be useful? Reforms on the banking side, reforms on the sort of CRA system side, reforms on the consumer side. Chi-Chi, we'll start with you, just in case you have an opinion.
I certainly do have an opinion, and I was going to stand up here and get all riled up and say, we need transparency, which we've talked about. We need standards. We need a uniform system so that people, banks, when they report information, they have strict guidelines as to categorize something and pound my fist. And I think some of my thunder was stolen by the previous panel, because I noted that most of the financial institutions on that panel also cited the lack of consistency, the lack of standards, expressed a frustration that, the same information may not necessarily mean the same thing from bank A to bank B. I certainly agree that that's a problem. And it's more than just an industry problem. I actually think it's a problem under the FCRA, because there's certainly, case law out there that says, if furnishers in an industry are to communicate meaningfully among themselves within the framework of the FCRA, it proves essential that they speak the same language and that important data be reported in categories about which there's genuine common understanding and agreement. And that's from a 10th Circuit case. And so I think speaking the same language, with the nationwide CRAs, you have the Metro 2 reporting format. Now, certainly we've had criticisms of individual elements of the Metro 2 format, but the fact that it exists and there's a common language, we think is a positive thing. And we don't know if it exists among the account screening CRAs, but if it doesn't, I think, it seems like one of the, market desires is for such a system now.
Can I just play off that, and before I ask your fellow panelists? So you talk about regulation around transparency, you talk about regulation around perhaps clarity, maybe requiring clarity of consistency in communications. Do you think that it is the business of government to also regulate the issue of policies? In other words, should government say, nobody reports anything under X amount of dollars, nobody reports anything that's just overdraft, nobody calls something fraud unless it's X, Y, or Z? Should that be required by government, or do you think that that's more consistent with the marketplace of banks producing and collecting information to assess risk?
So that's kind of a complex question. I think it depends on whether you're looking at the reporting role or the response to the information. So the reporting role, I think it's the role of government to mandate that there be a reporting format. I mean, the accuracy and integrity guidelines for furnishers do say, furnishers should use a standard report format that exists. So to the extent there is none, I think certainly, maximum possible accuracy, I think, means there should be one. Now, whether that reporting format prohibits the reporting of, certain amounts of debt to the bank, I think that, that's a trickier issue. I mean, I think actually from that perspective, then it's not so much the information, but how you react to the information and the role of government and supervision role. So, if you're going to say you have a negative history on check systems or account screening CRAs, we're not going to let you open an account. I think that is sort of an overreaction to risk, for example, because if somebody has a negative history because, they had a cascade of overdraft fees and they can't afford to pay, $200 in overdraft fees that occurred over one day, triggered by that $5 cup of coffee. Certainly shutting that person out forever from the banking account system just seems like a wrong, an overreaction to this risk. So I think, tailoring it to say, maybe this person needs a safe bank account, this person needs an account where they can write checks, but it has to be, you use certain tools to make sure they don't overdraw. I think, certainly government has a role there.
Nancy, your thoughts about reform from a consumer perspective?
Sure. I think when we talk about the reporting agencies, we definitely want to make the reporting system more user-friendly. So if those reports could be available in real time, that would be great. So when a consumer applies for a report, they get it, like we do our credit reports. If we could link that consumer account report to the annualcreditreport.com, so you're pulling your credit reports and your debit report at the same time. Make it simple. It's the same portal. It's the same idea. I'm getting information about my entire financial interrelationship with these institutions, the credit side and the debit side. For any of you who have ever applied for your report, the form is a little hinky in English versus Spanish, so it just could be made more user-friendly and a little more culturally appropriate. And I think the reporting agencies could provide some useful tips on how to have a conversation with financial institutions to clear items or negotiate items. And I think the agencies could provide training modules to help with bank-on campaigns on how to navigate these issues on their reports. I know Stuart talked about some public service announcement work that's going on, which I think is great. And if you could pair that with PSAs about bank-on and time it around a moment in the year when everybody's thinking about money, which is tax time. If we had a national campaign, people are very aware of what April 15th is. If we had a national campaign that talked about pull your credit report, pull your debit report, and get your taxes filed in this period of time, people are listening. When they're there filing their taxes, they're really thinking about money. They're really receptive to listening about how to build credit and how to fix their banking situation. So use that moment that the whole nation shares to create awareness about this and to make people be more informed, and use the reporting agencies to support that effort. On the financial institution side, I really think the root cause is overdraft fees and NSF fees. We've got to get a handle on that. I think those fees need a speed limit. There should be a cap on how much people can accrue in fees over the course of a year. Don't close their account if they hit the cap. Just stop offering that service to them. And the reporting agencies can keep track of that. So if you move to another bank, you can't get overdraft services at that bank during that year because you've hit your limit at this bank, right?
Can I just ask, to pull that to the CRA reform idea, are you suggesting that there should be regulations around either the role that overdraft plays in somebody being put on the list or in how they are assessed and screened?
More how they're assessed and how they're allowed to use the service of overdraft. And so,
but not in regard to CRA.
Not in regard to CRA. This is more products should not allow a consumer to have unlimited overdraft accumulation of fees. In other words, I have folks that spend $600 over the course of 6 months on overdraft fees. These are folks who are earning $1,100 a month. Now, there's a problem there. They're responsible, and the financial institution is responsible. There should be a cap. A bank teller should be saying, you've got a cash flow problem. Let's talk about it. This is not a good service for you. Let's turn it off because you hit the limit.
Definitely involve Nancy in your next panel on overdraft. Anthony, I want to ask you, it's sort of unfair to go last, but what is your extra wonderful idea about reform from a consumer perspective, and maybe either, again, from a consumer rights reform perspective or from a consumer fairness perspective on how banks, furnishers provide information or those who receive information?
I would echo what was already been said. I think creating, if we want to call it a second chance, but just some sort of standard formal pathway for folks to get back into banking, I think it's still lacking. It's great that these local efforts through Bank-Ons are providing pathways, but it really doesn't kind of like cover everyone else. And then this broader theme of collaboration, because let's be honest, the financial institutions are not going to be able to do it alone. It's the financial institutions working with the community-based organizations and the advocacy organizations, and then also working with local elected officials. And so to the extent possible, I know with the larger institutions, everything's coming up from the top, but to the extent possible, that they can get a little bit more granular and understand the nuances that happen to be within certain communities.
I think thank you. I think one of the wonderful surprises so far today is how much the comments of the consumer perspective echo so many of the comments from the financial institution perspective, at least in some respects. And part of what we heard a little bit in the first panel that I think dovetails in interesting ways around the question of growing industry consensus around some of these issues and the role that it can also play in reform in this area. So we heard a lot of great ideas. I'd love to turn it over to the audience now. We have some time for a few questions, and we have microphones and panelists.
And please keep your questions brief if you can, and direct them, if you direct them, to one or more persons on the panel. But we want to get in as many questions as possible. Thank you.
Yeah, go ahead, stand up.
I'm Jamie Applequist. I work with State Employees Credit Union. Jennifer spoke earlier, and we don't use CRAs on check screening. I really like Nancy's comments and Celia's earlier about having transparency on this side of the house, and I like the idea of pairing it with annual credit report. But Chi-Chi had a comment that concerns me that says some of the CRAs or the CRAs and the FIs have a relationship not to disclose, but it seems like that opposes law. Can you expand on what's being done to stop that?
So my concern was that there are some indications. I mean, we know for the nationwide CRAs, there's a problem with contracts that discourage the user of the report from sharing the copy they got with the consumer. In fact, California actually passed a law around this, and we actually think the FCRA prohibits it when there's an adverse action. We've seen indications that there might be similar contract provisions with account screening CRAs and financial institutions, and to the extent that they exist and they're a barrier for the financial institution to be able to share the report with the consumer at that moment, because as Nancy said, that's the teachable moment, right? That's the moment that the financial institution, if they want to work with the consumer, shows the report, here's the issue. To the extent that any contract provisions would prohibit that, we think that's a serious problem. What's being done, I don't know. This is something that we've just come across.
Thank you. Other questions?
So this question is for Nancy and hello. My name is Shamir. I'm the CFO at Simple, and Josh is co-founder. This question is really for Nancy and Chi-Chi. As you guys both pointed out, the fundamental problem is overdraft, right? There is so much overdraft that goes on, and that's really mostly the trigger that gets people into this downward spiral. Given that for a lot of banks, overdraft is one of the biggest sources of revenue, and a lot of banks would become unprofitable without overdraft revenue. Do you think that there's a tension between the prudential regulators and the consumer regulators in sort of broadening access versus profitability and safety and soundness?
Certainly the issues about overdraft, we have certainly taken a position that overdraft practices need to be reformed. The fees are too high. They're completely unreasonable. They were intended to be, they were intended to stop people from overdrawing, not as a revenue source, but because they've encouraged practices like high-to-low reordering and debit card overdrafts, which again, I think there's no reason for a debit card overdraft. It's just a high-cost loan. That being said, I don't think banks should be unprofitable. I think, yes, you can quote me. I think banks are entitled to, make their money and keep their doors open. I think they should be transparent and they should be upfront. And, I actually think models where someone charges, an upfront monthly fee to cover their costs are much preferable to a bank that makes their profit on the back end on penalty fees. It was the same with credit cards. We prefer to see an annual fee rather than hair trigger late payment fees. And so I have no problem. I know, there's been some controversy, but I've had no problem with an account that's, charges $8 a month, but that's all you get charged.
And I would agree with Chi-Chi. I mean, there is this tension, but when people incur an overdraft fee, it's because they're being overly optimistic that their situation's going to improve in the next day, right? That's how we behave with money, isn't it? And so if that's a profitable line for the bank, it's taking advantage of this inherent behavior. We're not going to the bank and applying for a loan for $24 to cover that debit transaction, are we? We're just we've been pre-approved with the overdraft fee. And it's too much. It's a predatory level when this happens time again. If it happens once a year, that's one thing. But if it's happening consistently and nobody's stepping in to stop it, then it's a real problem. So I recognize that tension, but I think banks are really creative. And they can come up with ways of being profitable without taking advantage of the overdraft fee as a service.
Other audience questions? Oh, good.
Hi, Catherine Lucas McKay from CFED. In the first panel, we heard from financial institutions about having a denial rate for opening new accounts around 1%. Several people said 99%. And here we hear at the top that 38% of participants in the AFCO adult research were flagged for fraud. So clearly that's not an apples to apples comparison. You have a much higher financial vulnerability level in people who are participating in employment programs, but it seems like that is very clearly where issues are concentrated. So are there things that as consumer advocates you all can recommend to the financial institutions that may have less expertise in dealing with lower income and financially vulnerable communities that are particularly helpful for those families and individuals to be able to either address problems in account history that they already have or to successfully manage a first account or a second chance account?
Thanks. So I had one idea that I didn't get a chance to share when we were talking about reforms, which is if banks were interested in having something like a consumer ombudsman, that people knew there's a name, there's a photo, and there's a phone number. And they can call that person and put their case forward, and that person has decision-making powers to negotiate a resolution with them, a real person. You know, banking is about relationships. That's the whole point of Bank On, isn't it? We're bolstering someone by saying, I know so-and-so in that branch, go down there, they're expecting you to open up that account. So having a consumer ombudsman at a bank would really help with that relationship sense. That person doesn't feel like they're getting on that hold spin for hours, right? They keep getting transferred, keep telling their story, nobody can make a decision. There's a point person that they can go to. I think that would be helpful.
I was struck by the number that was coming out of LA for the young adults who are opening accounts and are already getting flagged. And we've seen instances back in the great city of Newark where parents would use the name of children, sometimes for utility bills, sometimes to open up accounts. And when the children grow to adulthood, they again have these kind of pre-existing barriers they had nothing to know, they were completely clueless about. And you know, I would hypothesize that when the institutions look at these individuals, it looks like blatant fraud, maybe in some cases, because it's the individual and it's the direct action that that name might have taken. And so again, this is an example of like maybe a nuance that needs to be considered and looked at. And so I'd like to kind of go back to the data. And so, you know, looking at local markets as their own rather than just kind of this national map and trying to peel back the layers of what's going on in that community. New Haven actually did this wonderful piece in 2012, a community impact banking report where they surveyed and brought in community members and kind of like scored all the institutions on a very transparent kind of like criteria and said how accessible they were. And out of that local report, you actually saw changes on the ground, including translations on ATMs that didn't exist because they had a huge ethnic population that, again, were being kind of like disenfranchised with understanding what was going on in the ATM. And so, you know, again, I go back to that earlier theme is, you know, where you can, where possible, you know, collaborate with your local partners, your local stakeholders, and I think you can get a more clear understanding what's really happening on the ground.
I want to steal the opportunity of a last question if I could, unless there's somebody. The thing that keeps pounding in my head as I've been listening to this panel is one of my wonky secrets, which is I adore Venn diagrams. And in my head, I see a very large center of this Venn diagram between regulatory interests, banking interests, consumer interests. I wonder how you would populate the middle of that Venn diagram, particularly having thought about what you learned from the first panel. What do we all agree? What do we all seem to want? And by we all, I'm absolutely including financial institutions. Nancy?
You know, some of the things that I've been hearing and that I think we all want is information, transparency, consistency, predictability. I don't think that would contradict anything that was said earlier today. So, transparency.
Because every bank wants to know whether they have a check kiter who's trying to get into their bank, right?
Absolutely.
And none of us are trying to put together programs that help check kiters kite checks.
Exactly.
Right, okay. Just to be clear. Chi-Chi?
You know, I would agree with what Nancy said. It seemed like, you know, information transparency, standards, you know, a common language is something that we seem to all agree on. I think not all sectors maybe of industry, but there's certain elements that seem to agree, you know, we got to get a handle on overdraft practices.
You'd put that right in the middle of Venn diagrams. All right.
Maybe a little bit off to, you know.
Other little intersection points of a really good Venn diagram. Anthony, what do you hear as consistent?
I don't know. I'm just drawn to this bigger point where this is an area of interest to everybody in this room, right? We are talking about access to, again, a fundamental element. So I think communication is probably the biggest piece, and then having a nuanced communication so that it involves a look to what's going on locally. Whether you are trying to fight poverty, or whether you're trying to increase your client base. I mean, we're talking about, 1 in 12 households in the United States are unbanked. 1 in 12. That's 10 million households that, again, are disconnected. So that's the customer base for the institutions in the room. And then for local, either government officials or local electeds, we're talking about, again, a basic public interest. And so let's figure it out how we can develop more solutions locally, the way San Francisco did, I think, with modeling the Bank On model, and let's just get at the work.
Joe Valenti, Center for American Progress. I like the consumer transparency concepts that have been raised. The one fear I have thinking about where we've gone with credit reporting in the past 10 years is that you end up with a cottage industry that's rent-seeking on the basis of the information in CRAs. That you would have, oh, we'll sign up for this service and we'll make sure that nobody is using your name for bank fraud, and just another rent-seeking opportunity. How would we prevent that from happening if we do make consumers' debit reports more accessible and available?
That is an excellent point. I mean, certainly, we've expressed concerns that some of the products out there, and we're not just talking about credit repair, but some of the, more available on the market products out there have, been extraordinarily expensive for what they're delivering consumers. And yeah, that would be a concern in this space. I mean, early in the earlier panel, there was a product mentioned about, consumers know a lot about their credit score because of a product. Well, we actually think they shouldn't have had to pay for that information. And we certainly think here it's the same. They shouldn't have to pay. Nobody should be making what we think are questionable pitches. You need this product and to pay $20 a month so that you're not the victim of identity theft in your bank account. Yeah, I totally agree, and I think we need to think about that too.
Okay, I want to thank our panel. Please help me thank them. Jonathan, Anthony, Chi-Chi, Nancy, thank you so much. That was sort of a great sort of second feature, if you will, to our three-feature day. And right after lunch, actually right during lunch, we'll be having our third panel. And so about lunch, If you go out one of the two side doors there, you'll see a lunch lineup. You can pick up your sandwiches and your sodas or what other drinks and other things like that, and then bring them back in here because we're going to start again in just 15 minutes. So thank you again, and we'll see you in 15 minutes.